Let me welcome you to today's lunch talk, in which we will discuss inflation and asset prices. And I'm very glad to have Moritz Schularick here, now president of the Kiel Institute for the World Economy, and you have that position since June. Before we go into the topic, I always like to talk about my counterpart, about you, and how does it feel in this new position? How were you welcomed, and did your life change?
Well, thanks. First of all, thanks for having me. Very happy to be here and learn about and talk and have this conversation with you and learn about your work. It feels very good. It's a big job. It's a job that has certainly very different sides to it than just being a university professor. So we interact very much a lot with the with policymakers both in Berlin and in Frankfurt and in Brussels, and we're building an international or rebuilding a big international network. We've set up a very fruitful conversation with CPR, the European network of research economists. So we have a lot of work carved out for us, but so far it's been a tremendous experience.
In the work that you're planning with CPR, it will have an international focus as well?
Yes, we're setting up a research hub joined with CPR in Berlin, which is also part of the plan for the Kiel Institute, is to have a stronger presence in Berlin and advise the government, but also contribute to the public debate when it comes to international economic policy issues, which is, I think it's fair to say, not Germany's forte to be present and have a very sort of active and high-level debates on things like the international financial system or the global trade system, or even things like geopolitics and geoeconomics. And we want to do that and contribute to that, building that intellectual infrastructure in Berlin.
No, I think it's obviously very important, and we will talk about it then in our further conversation on asset prices and inflation. Obviously, geoeconomics is playing an increasing role, and it's meant to stay that. So strengthen the intellectual capacity in Germany will also make a good contribution to the European discussion. Maybe one other point before we go there, because I would like also in those conversations, young scholars maybe that listen in and look at us to get motivation for their career, for their life as an economist. And you stand out among German economists for also your policy involvement. And what motivates you to get out of the academia and be more policy involved now in that position? Did you have that motivation from the start, or has it evolved?
That's a very good question. I think it has evolved over time. I think you see how the research that you're doing is also shaping the debate, and that's I think I was very fortunate that my early research, if you think about the work I've done with Alan Taylor on credit booms, has been quite influential in designing macroprudential frameworks and thinking differently about the origins of financial crises. So it wasn't that, but I think there is a moment now where, especially when it comes to questions of international economics, where we need to rethink some of the pillars that German and European economic policy rested on for the past 30 years. So I'm talking about globalization and the future of global market integration, where certainly Germany has to some extent embraced a slightly naive version maybe of globalization, and has turned a blind eye to the security policy implications, to the geopolitical implications, to questions of dependency. I think last year's debate on the Russian gas dependence was certainly an eye-opener for me, to what extent our country, and I'm talking about Germany now, and I think that's not necessarily true in the rest of Europe, but to what extent we still don't have I think an intellectual and academic debate on par with our role in the world. And so I think for me that was a very last year's gas debate, and sort of also seeing like firsthand how in very existential questions how policy is made, and not, and we'll probably talk about crisis resolution in a second. Also having the feeling that Europe and Germany especially isn't particularly good in crisis management, and we need to get better because we tend to lose out in crises. I think if you look at Corona again, we have taken a big, there's a big gap now in the economic performance between Europe and the US over the past 3-4 years. That wasn't so different. Think about 2008, started off as a big crisis in the American real estate sector and the American banking system. And 5 to 10 years later, it looked like Europe was the main victim of it. So I think we need to get better also from a European perspective, and contributing to that was a big factor for me.
And you now alluded to it, financial stability issues, crises are a big part of your work, how to look at monetary policy and asset price developments. And one common denominator of your work is that you like big, long historical data sets. And that kind of contrasts with other work that is done in economics, where you are very worried about structural changes and how much you can say. While for you, this kind of wandering across time doesn't seem to be an issue. So maybe also short work, how you look at this question of this, looking at the very long developments and what you think we can learn from this instead of focusing maybe on the more current juncture only in order to get economic insight.
It's a great question. So let me start by saying I don't think it's either or. I think you can have both approaches, and I think it's part of an active research field that, great research I think is always question driven, not method driven. And for some questions, you simply need to have a broader canvas and go back in time. If you think about financial stability questions, if you want to study financial crises, luckily they don't happen every year. So if you want to study rare events like crises and understand the dynamics and the build-up, if you want to understand the financial cycle, which we think has a longer frequency than the business cycle. But even the business cycle, we think like recessions happen like maybe every 8 to 10 years, and we have macro data for most economies for maybe 100, 150 years. So a lot of our macro is built on, maybe, what do we have, 10, 15 business cycles. If you look at it from this perspective, that actually all of our macro is built on, or like at least our short-run macro is built on something like data for 15 business cycles per country that we have data for in the last 100, 150 years. Doesn't sound that reassuring, does it? So, and it gets even worse when you talk about crises. The average country in the last century or so might have had 4 or 5 financial crises. So they happen like, probably roughly every 20, 25 years. So you want to study those and have a sufficient number of observations, you need to go back in time. And obviously then you need to deal with questions. Is this still the same country? The alternative is you go cross-country and then you know for sure that it's not the same country, and your empirical analysis comes with all of that. But let me stress again, I don't think it's an either or. I don't think there's anything wrong with zooming in on a very micro level on some of the lessons we've learned in the 2008 crisis. I think that's very complementary. There was a moment after 2008 where sort of macro had a little bit of soul searching to do, because looking at this letter that was sent to the then Queen of England, is like there was this collective failure of imagination, that we couldn't just imagine that things could go so wrong on such a big level. And so there was a lot of soul searching, there was a lot of broad exploration. So what do we know about finance and the macroeconomy? What do we know about the origins of financial crises? And I think in this moment it was very important to have this longer run perspective.
No, I think I fully agree. It's a great perspective, a complementary perspective, and also if you combine it methodologically with other approaches can be very fruitful. Now, to kick off our discussion on inflation asset prices, maybe you want to offer a few thoughts at the start. Given the current environment that we are seeing and given also your background, what do you see as key developments or key concerns that you have?
Right. So I think it ties into what we just said. I think it's beyond question that we've just had a big inflation surprise. Central banks were, caught off guard to some extent by what happened over the past 2 years, and we've seen some very clear developments in asset markets at the same time that help us go back and revisit some of these, I think, very relevant, very important questions about how different asset classes hedge against inflation, how asset returns are affected by inflation. And I think that's not only an important perspective from the perspective of governments and government debt. Government debt to GDP ratios have fallen quite a lot because of the increase in the nominal GDP, but also from a household perspective. We want to understand, if you want to understand what are the distributional effects of inflation. We're very quick usually to say, oh, it's bad for poor people or like low-income households, and because they have their portfolios are not hedged and they have a lot of cash, and I mean not a lot, but the big part of their portfolios in cash, so they would be most affected by inflation. So for all of these questions, we need to understand how asset returns are affected by inflation, and as it is so often in our field, the moment it sounds very easy, like ex ante, you would say like, oh, they're real assets and real assets are not affected. So if there's an inflation outburst, you want to own stocks, you want to own houses, you want to own commodities maybe. And you don't want to own government bonds because they're nominal instruments and they go down in value a lot. And then interest rates also tend to rise, and that makes long duration assets less attractive. And I guess a lot of that is true, but then as is so often, if you look more into detail, it's not so clear. So the stock market, for example, has reacted very badly to the inflation outburst. I think we're talking in most countries, in Europe at least now, about a substantial correction of the housing market. So I think in Germany we have this, we've actually built a new house price index called the Greiks, which uses transaction data. And in most cities, house prices are now down in real terms 20-25%. So it looks like housing was actually a very bad asset to own over the last 3 years during that inflation outburst. And I think these are questions that sort of, given the recent experience, led us with a team of co-authors from Bonn, actually, with Hyun Kim and Lorenz Ronaldi, look at the history of inflation surprises and asset returns. And the big ingredient to study asset returns and inflation surprises is to get inflation surprises in history. Again, you need to go back in time. Otherwise, you'll be left, like if you study the Great Moderation, well, there were no inflation surprises. So we can make all kinds of suggestions how inflation and asset prices would be correlated, but without inflation surprises, you can't say much. So we went back, and actually what we did, and we're kind of proud of, is we found inflation forecasts going back almost to World War II. That were done by the OECD, and they were in the archives of the OECD. So OECD researchers and economists had these wrote down what they think inflation is going to be in France next year, and then we have a forecast and we compare that with the outcome, and we can build a series of inflation surprises. But we can even go further. We can go back all the way back to the late 19th century, if we're willing to use statistical methods to extract inflation expectations from economic data. And then when you do that, you see that a lot of what we think is true, but it's as usual it's more nuanced. So if you look at stock prices, for example, they tend to go down after inflation surprises. Mm-hmm. And they tend to go down, so in line with what we've observed in the past few years, they tend to go down, especially in particular in circumstances where you'd expect the central bank to increase interest rates in reaction to the inflation surprise. So stock prices turn out to be very sensitive to actually, we think, even nominal interest rates, but maybe it's a real interest rate story also behind there. But so the stock price hedge of inflation surprises is highly contingent on what the monetary policy response is. And what we've seen, I think, central banks were certainly a little bit late in reacting to that inflation pressure that we've seen in the recent years. But then they've increased interest rates quite strongly and very forcefully. And it was that response, although they've increased interest rates less than inflation, so real interest rates, at least current real interest rates, have actually been very negative. It was very bad for the stock market. So, and the same is true for the housing market. Also, the housing market seems to react a lot to just the interest rate level. And I think if you look at what's happening now around Europe, and I think it doesn't make a lot of difference if you look at Paris or Berlin or Stockholm, the increase in interest rate means that mortgage payments, interest payments on housing debt, either for new apartments in markets where you have very long fixed rate mortgages, or even for the existing stock in markets where you have floating rate mortgages have, I say like more or less quadrupled over the past 2 years. And of course that's bad for the housing market. So I think there's some lessons here. We find that the hedge that works most consistently and irrespective largely also of the response of monetary authorities is actually commodities.
That is a very interesting point. So, because it puts much of the discussion that exists actually also on monetary policy in this historical context, right? So, I mean, what you say about the adjustment of equity, the adjustment of real estate prices or of bonds, is not, I think, a surprise to many in financial markets in a way. I mean, that it happened, yes, the fact that it happened, but if you think about the mechanics, because you change the risk-free return, and that also means that people would change their portfolio allocation, and therefore prices would adjust. What I find very interesting is that when we think about it, most people first mention this period of ultra-low rates. We had a secular decline in the monetary policy rate and therefore in financial market rates that led people to increase their risk exposure, go into different assets. Now that this has been reversed by surprise, then obviously also portfolios adjust or need to adjust accordingly, and we see a reversal of prices as you were discussing. So when in your research, when you say and you find that regularity over history, it basically says that what we thought is an exceptional situation with this ultra-low interest rates is not so exceptional, but you see it more regularly, that as a after period of, if you wish, relatively lenient accommodative monetary policy, you have those kind of surprise adjustments that come via shocks or endogenously driven.
That is true. So that is other work we've done very strongly suggests that periods of sustained, let me call it loose monetary policy. What does that mean? Loose means when central banks keep the policy rate below what we as an economists think of as the equilibrium rate, so the Wixelian, the R star, the real neutral rate, then such you prepare the ground for financial, I would call it like, it's not we say like this definitely leads to crisis, And central banks do that for a reason, and sometimes they're very good reason to do that. But if you have these sustained periods of very loose monetary policy, of very low interest rates relative to some benchmark, you see indeed that the phenomena that we usually think of as being associated with rising instability, booming credit markets, booming asset markets, very high valuations for interest rate sensitive assets, that those phenomena actually follow. And then it's not untricky to get out of that, because what options do policymakers have at that point? They could raise interest rates. But if you do that in a way that shocks the market, you're as likely to make to trigger the crisis, because all of a sudden people have to wake up and say, oh, this leveraged business model that I had doesn't work anymore. So that comes with a risk too. The other way is to use macroprudential policy tools and kind of try to get a little bit of that steam out of the boiler room, if you will, in financial markets. But those tools are, not very well, not tested very well, and we often don't know how to use them exactly. Like, how much do we increase some macroprudential policy measures to actually come to a stable point? And there's the other thing. I mean, this is other research that we've done recently, which is that if you look at what's driving financial stability risks, it's typically the large financial institutions that you want to look. So macroprudential policy and microprudential policy for the large financial institutions is kind of the same thing. So you really have to target a few players, and that's not an easy proposition, also from a political economy point of view.
Lots of follow-up questions. A, on how do you look then on monetary policy, or B, what are the mechanisms of financial instability? Maybe first briefly on monetary policy. Given what you said, are you then a proponent of a monetary policy that leans against the wind, which means that monetary policy should not only look at inflation, but also look at financial stability and try to prevent bubbles from bursting in being tighter, or is that not a good position?
So I think once you are in this boom, credit asset price boom world, surprising the market with monetary policy tightening is a bad idea. It typically triggers the crisis. You could see this in, so this is a little bit the story that Milton Friedman and Anna Schwartz tell also in their book about the Great Depression in America, that is, say, like, this tightening by the Fed, it was targeted at the stock market to get the speculation out of the stock market. That was the shock that kind of triggered the depression. And if you look at the Scandinavian banking crisis at the beginning of the 1990s, for example, they were also triggered by effectively by the Bundesbank, because the Bundesbank raised interest rates after German reunification. The other European countries were part of the European exchange rate mechanism, and so they had to increase interest rates as well. And that, if you will, even exogenous factor that tightened interest rates or increased interest rates in Denmark and Sweden, etc., was what triggered then the turnaround in the crisis. So I think the art of central banking is indeed to prevent these overheated asset markets from occurring. Once you're in there are no easy solutions, unless, and that's a question for where much more research is needed to answer that. Unless you take the point of view that maybe with appropriate institutions, and we are in one, if they're in place, you can deal with the fallout from crises. Because otherwise you're always in this world where you have to, if I keep monetary policy tighter than I would otherwise, I have costs, more unemployment, less output, and I need to balance those costs ex ante against the cost of the crisis. So in an ideal world, you might want to say, well, maybe I don't incur these costs, I regulate as well as we can, but then I have the institutions in place to deal with the crisis if it really happens.
That brings us to the crisis phenomenon as such and the crisis mechanism. So the experience that we have had, yes, so far is that we had the inflation surprise. Afterwards, then, or with that, the adjustment of monetary policy, drastic increase in monetary policy rates, asset price adjustment. Then we had first problems in the commodity market, actually, with liquidity, derivatives, and governments had to step in providing liquidity guarantees. That could be solved, but was a critical situation. Then we had this spring in the US, the Silicon Valley Bank. There the problem was, yes, the adjustment of bond prices. And again, that resulted in a banking crisis, in liquidity problems, and then that went into solvency problems. We have real estate, as you also mentioned, still pending, which has not resulted in Europe so far in a crisis, and that's good, and is also testimony of the robustness that we have in the system. But we have on the banking side equity as well, which in the case of Credit Suisse was an important factor. And then what we saw in unfolding that crisis was basically the unforeseen dimension of liquidity. So in your research, or from your perspective, I mean, when you say there is this link between the inflation asset price adjustment from a hedging perspective, but also from a financial stability perspective, what do you see as the main mechanism of propagation of financial instability?
Right. So I think there can be two sources of sort of instability of banking sector problems. And they can be either come on the liability side of the banks, or they can be on the asset side of the banks. On the liability side of the banks, and I think we've all looked at this, is the funding problems that can occur, the bank runs that can occur, that people take their money out. And for those, I think we have relatively good ideas what to do, deposit insurance being one, liquidity facilities being another, that help banks weather these liquidity storms. And I would say this is pretty much also my take of the events this spring. It wasn't so much a credit risk. It wasn't a problem. The assets had to be revalued because of higher interest rates. So there was this issue in terms of the mark-to-market valuation. But it wasn't like that, Silicon Valley Bank and others that were invested in reasonably safe assets. The credit risk per se was not the risk, it was the interest rate risk. Systemic banking crises, the ones that are really hard to deal with, are typically issues on the asset side. This is when we looked at China now. We know there are a lot of financial players that have a lot of exposure to real estate developers whose assets are just not worth what people thought they were worth. And I think that's what happened in 2008. And that's the typical scenario where the bank balance sheet, the asset side of financial institutions is the source, and those tend to be much harder to clean up and have higher cost, and they tend to be systemic in the sense that, if you look what modern banks do, a lot of that is effectively macro risks that are in the books, things that are very hard to diversify when possible. Banks take a lot of risk on essentially on the health of the housing market, which is, there's maybe parts of some area of Luxembourg does better than another area of Luxembourg, but overall, it's a very correlated macro market, and the same is true for Germany and France and other countries. And the other risk they take is interest rate risk. So these are two macro risks that are very hard to diversify. And when we have problems on either of this, especially housing, but sometimes it's also the corporate sector, as in China, it really becomes much harder because someone has to incur real losses, and it doesn't help with these liquidity issues. You can always kind of sit it out, and eventually the asset side is fine. You can backstop that on the and you can even prevent these inefficient runs. When you have systemic crisis on the asset side, things are much more difficult. And I think here the prime focus is China, where we had if you will, the mother or the father of all real estate credit-driven boom and bust cycles in the past decade. It's over now, and there's actually some interesting parallels to the Eurozone, in the sense that at the same time as China now has this big property bust and all the problems with the real estate developers and the banks that are linked to that, the funding model of the local governments was also tied to the real estate sector health, because they're financing themselves through land sales. So this is not comparable now to Ireland and Spain in 2007-8, but also there we've seen how clearly often public budgets are linked to the transaction volumes in the real estate sector, the health of the housing market. And so what's happening there now is that at the same time as you have this private sector credit crunch, you have a public sector financing crunch, because the local governments need to scale back and balance their books. And that, I think, is something that we've learned from the research in the past decade, that having both the private sector sort of, go into some kind of austerity mode and the public sector go into an austerity mode, both at the same time doesn't tend to be a good idea for growth and economic development.
Now it creates quite some problems. We have, and you said, our own European experience with that.
To some extent,
in the aftermath or during the great financial crisis and the subsequent sovereign debt crisis. But I must say also, and that I think for me is the lesson of the spring, that Europe has actually moved on. And yes, I mean, countries are affected by the macro developments and risk are correlated. At the same time, we have seen that Europe and European banks also did rather well and proved to be resilient in this situation, because we just have tremendously improved the infrastructure and the balance sheets of banks and the safety margins that we have in there with much more capital than we had, for example, in the in the past crisis 12 years ago. And I think this was also confirmed by the EBA stress test this summer, that actually showed that overall the banking system is more resilient, much more resilient than it was in the past. We also see that this time around, we don't have the same type of a credit cycle, credit boom that drove the past crisis, that eventually also led to problems, the systemic problems in Spain and Ireland. So I think the situation has evolved and our European infrastructure has evolved. But still, if you look at it and also think about the policy initiatives that you would like to see on the back of this, forward-looking, what is it that comes to your mind?
First of all, let me say I totally agree. I think we've made some progress, or we've made progress in Europe. We've become more resilient. We are in better shape also to deal with crises. We've improved a lot of what the banking sector does. I still think we shouldn't fool ourselves. If we get a 30, 40, 50% nominal correction of house prices, our banks will be in trouble. Ultimately, that is because they sit on these correlated risks, because so much of their business is mortgage business that only governments ultimately can insure. And I think that's a structural problem that we have to deal with. If you look at the average bank balance sheet in Europe now, 60%, 2/3 or so are linked to basically mortgages and real estate. So if we have a crisis in the real estate sector, a real crisis, which we don't have now, there will be trouble, and it is a structural feature that we have big financial systems that sit on ultimately correlated and undiversifiable risk linked to macro factors such as the housing market. This being said, I would say the glass is half full for Europe, and we've done much better. We're much more resilient. I still worry overall about our capacity to be crisis fighters. Even if you look at now at the pandemic and then the aggression and the invasion of Ukraine, and you just look at how the European and the American economy has performed since 2019, there's again a big gap. So we've done well, but we've done next generation EU. The banks seem reasonably stable, but at the end of the day, if I look at the indicators, we've lost another 10-15% in growth cumulatively relative to the US over the last 5 years. Now you can say we had different shocks. The Ukraine situation was much more present for us, and we know from the war in our neighborhood is a supply shock, and the US had more of a demand shock because of the fiscal expenditures. But it doesn't quite. I still want us to become better at crisis management and not lose so much output relative to trend, and then slowly clawing back. So having prevented a hot crisis, great. I still wish we'd be better on macro performance.
In generally, the notion that with the pandemic, monetary and fiscal policies were aligned, also in Europe. Fiscal policy supporting the economy, monetary policy being accommodative, as we said before, for good reasons. Then with the cost of living crisis, this became more complicated, also because monetary policy needed to tighten. Fiscal policies remained, at least for a while, somewhat expansionary, now pulling back. So how should we then think about the policy mix in Europe in such a crisis situation? What would you have liked to see then more that was done? Which in my perspective, actually, I think was, I must say, I found it rather measured, the reaction during the pandemic, and kind of adequate in terms of size. But you seem to be asking for more of a pressure economy. Is this the way to go?
So I think I want to give you one example where my thinking has evolved a little bit. And where what ties into, I think, a bigger theme of we are not very good in Europe, and partly for well understood institutional reasons to change track. We build these institutions, and 27 or how many governments have to agree, and then there's a certain way we do things, and then getting out of this is very slow. So we typically, greatest respect for my colleagues at the ECB, but there's also like a sort of a little bit of a pattern that there was a tick, there always a tick late. Tick late to start, a tick late to stop, because there's always this European consensus building, and in case of doubt, the consensus building and the inertia built into this European institutional framework always costs you another quarter. So 2 or 3 months to get stuff agreed upon. And 2 or 3 months in crisis situations, or especially if you look at a macro, these turning points in macro can be quite a lot. What I wish is, and this is where I wanted to say where my thinking has changed a little bit, and where I think it'd be nice to have a more open discussion also in Europe, is we tend to think of monetary policy, and for that purpose, all policies that stabilize aggregate demand as demand side only. There's nothing structural. We just keep things running, so to say. And what has happened over the past years is that there's more and more academic papers, more and more academic thinking coming out that thinks about the longer run implications of things that we see as non-structural and short-term, such as monetary and fiscal policy. So to give you 3 examples that I find, when I need to think maybe we want more of a pressure cooker economy. Why? One example comes from the firm growth literature, where people argue that for firm growth, for startups to succeed, for new businesses to emerge, but then also to scale up relatively quickly, it's very important that you have sufficient aggregate demand. I think it's quite intuitive. Like if you found a company into some kind of depressed environment, you want to have a really, really hard time, and you want to succeed with less probability. But then we know what drives growth in the long run is the success of these new companies. So startups go down, business formation goes down, and sort of stabilizing aggregate. And this is one channel where stabilizing aggregate demand actually has long run impact. Because you stabilize aggregate demand, you make sure that these business formations still happen and they still succeed and grow and scale. So I'm just saying this is one point where stabilization policy, which we in Europe also think of, this is just the demand side, actually has very important long-run supply-side consequences. These are the companies that make us grow in the future. And if we're missing out on that cohort, we have a problem far away in the future. Another example is a paper, actually, former PhD student of mine was a co-author, presented at Jackson Hole this summer, the link between monetary policy and innovation. So what Göran Ma and Kasper Zimmermann show in this paper is that monetary policy has measurable impact on everything that we think is innovation, startup activity, even patenting. And again, the channel might be very similar to the one that I mentioned. But it could also be one that runs through risk-taking in financial markets. The venture capital guys are much more active when the economy is running hot and when interest rates are low. Then right now it's not a good time for them, so to say. So the different channels. And the last bit of evidence I want to mention is a paper by actually my co-authors of many years, Oscar Jordan, Alan Taylor, and Sanjay Singh from Davis, who show that you can measure the effect of monetary policy over very long. Like they show that policy shocks can have typically have an effect on economic output for up to a decade, and they rationalize in the same way. They say like there is an effect on total factor productivity, and ultimately micro channel might again be firm growth, might be innovation, but sort of this neat separation and this European dismissing, it's just short-run demand stabilization. We are supply-siders. That stuff is not so clear anymore.
No, there is a very valid point in that, and I think there's already more long-standing research that stability has an impact on investment, and I think also the focus on investment is that we are currently having in the policy discussion is a very important one. What mechanism prevails, because at the same time you have a discussion that low financing costs allow low productivity firms to survive, which may lower actually the overall productivity in the economy. And what is then the key driver in aggregate maybe is still more of an open issue. One short remark on my side on what you said on the policy, and then I would like to also look a bit more into the medium-term future. When you said decision-making in Europe tends to be slow, just also by the fact that you have to agree with the 20 euro area countries, or you have to agree with the 27. I still have the feeling that when it came in the pandemic, Europe as a region was the first one that actually was able to formulate a longer-term perspective with Next Generation EU, how to get out of this and how to transform the economy. And that I found actually quite remarkable, while in that instance, other even countries like the US, or not to talk of other regions, had not formulated that as a vision. That just to give some kind of, where I think, if you wish, a counterexample, that it hasn't always to be slow. I think there can be also quite some movement. And if you look internationally, for example, what we did with the vaccination pass that we had was kind of pretty internationally path-breaking and was very successful. But let us now turn for a moment to the medium-term outlook. And that is the question, what should we expect about inflation in the medium term? Should we expect higher inflation in the medium term? What are the driving factors? Some people quote the energy transition or geoeconomic fragmentation, and then also what can we expect for real rates in the medium term? What's your view on this?
So the medium term is a tricky business. I think in the short term, and I might be wrong about this. In the short term, I'm not too worried about the inflation outlook, especially in Europe. I think the ECB has reacted very forcefully and hiked interest rates into what is essentially a supply shock, and has cooled down the economy. And as these effects, as the economy cools down even more because of the interest rate hikes, the inflationary pressures will fade. I don't see that we even went into this inflation spike with an overheated economy in Europe. We're still, if you look at potential, I think for the US you can make that case. But the medium run is tricky for two reasons. I think the problems that we have in China right now, and I think that's underappreciated actually in Europe, and partly even in the US, where we still have a debate that's focused on China as this strategic rival, this big competitor, this strong economy that will make it very hard for us to compete. I think people underestimate the degree of structural problems that there are in China, both in the short run, but also in the medium run. And the temptation for the Chinese policymakers, the easiest path they can go down and will go down for sure is to try to do what Germany did in the 2000s when we had our crisis, namely to export their way out of it. Everything else, getting Chinese domestic growth on a different footing, shifting from the capital investment heavy to consumption, total factor productivity, being smarter about doing things, would need a bunch of reforms that the current leadership is absolutely unwilling to undertake. The thing that will work, and we'll see this in the next years, is flooding world markets with if you will, even cheaper Chinese products, from EVs to mass-produced, turbines and panels and air conditioners and whatnot, irrespective of the profitability, almost irrespective of profitability. I think the excess capacity that China has built in a lot of these industries, and the car industry in recent years, is very large. So now it comes then, what is the medium term? So in the next 3, 4, 5 years, I think we're actually going to come back to a model where China is going to export deflation, if you will, to the rest of the world, simply because it's the only way out for them. Beyond that, things get really hard to see. I mean, we have forces, if you look at the demographics in Europe, the US, China, that don't look great at all. We have a debate out there which is tightly linked. What happens to the saving investment supply in the future? Clearly, we need to invest more for the green transition, but we also age at the same time, and that might increase savings supply. So, where real interest rates will settle, and where ultimately sort of the inflation outlook is very, I think it's very hard to say at this moment. I would, if you put you force me to, and I'll take that. I still think that the outlook is for a real interest rate level that is relatively low. The forces that have been driving low real interest rates in the past decade or two, I think, are to some extent there to stay. I don't think we're going to go back to these zero interest rates, but I think we're going to come down from where we are now.
Which in my understanding is actually also very much in line with what, say, the IMF predicts will happen, that yes, real rates, long-term real rates have moved somewhat up, but not too much, and will be not too far away from zero in real terms,
right,
even forward-looking, due to the factors that you mentioned. I think we have had a great talk.
Thank you.
Thanks
for the time.
Big fun chatting with you, and I think we covered a great deal of ground on historical sources of crisis, how to react to them, what was done in Europe, what was done in other countries, and how to look forward. Thank you very much, Moritz.
Wonderful. Thanks for having me.